Hello, everyone. This is Timothy Dial with Nexa Mortgage, and I was just going to put this little video together because I've done videos on this down payment assistance grant before. They've been very short videos, just explain just a little bit about them. I'm going to get a little bit more detailed in this video and go through some things that I think are going to be very valuable for customers who start this program. Because I get questions even as we're going through the program and I'm helping customers get the down payment assistance. There are things that come up that are confusing to people and things like that. So I like to cover those more on the front end in this video so that you're not surprised as we get more into the program. And so I'm going to go through some things. There's also a slideshow then I'm going to go through about the down payment assistance grant. I'm not going to go through all the slides because many of them are more lender specific or more for me than they are for you. Um, and so I'm only going to go through like the first 10 or 11, something like that, because those are the ones that are more relevant to customers. So, um, but just to give you a little bit of an example, this down payment assistance program, the nice thing about it is that they're actually giving you the 3.5% for the down payment as a grant instead of what most down payment assistance programs do is they'll give you the 3.5%, but then they'll put a second mortgage on your property for that 3.5%. It'll either sit there until you sell the house or refinance it, and then you have to pay it back, or you have to start paying it back immediately after you close. And it's an extra payment you're making each month, and therefore your overall cost or overall payments for your mortgage are a little bit higher in that situation. But with this down payment assistance grant, they're giving you the 3.5% as a grant. So it's actually like they're counting it as if you have, like, let's say you have a $200,000 house, they're giving you 7,000 for the grant. Then they're counting as if you have an extra $7,000 that goes towards that closing. And then you don't have to pay it back. So let's say you refinance your house in a year, you already had 3.5% equity in the house. So when you refinance it in a year, you don't have to pay anything back, and it's just free and clear. So it's a very nice program. One thing that I always like to tell people is even though they are giving you 3.5% for the grant, closing costs on this program are a little bit higher than a normal, just doing like a normal FHA loan. So there's a little bit of a difference there, but it's still, you're going to bring usually several $1,000s less to the closing, and that's the key. Now, the other nice thing about it is that a seller cannot provide you with down payment funds, but the seller can pay closing costs. And FHA allows the seller to pay up to 6% of the purchase price toward costs. Most of the time, if you get the seller to pay the full 6%, that's going to cover all the costs, even on this program, and you're not going to have to bring anything or hardly anything to the closing. Most of the time, you can't get a seller to pay a full 6%, but a lot of times you get them to pay, anywhere from 2 to 4% toward the cost, depending on the price of the home. I just had one where the seller's paying 5,000. I had another one earlier this year where the seller was paying 7,800, and I had another one where the seller was paying over 8,000. So just to give you an example, in that situation, the one where the seller's paying 7,800, which was here recently, on that one, I think the buyer ended up having to bring about 2,000 at closing. So, and they would have had to bring over 10,000 at closing on an FHA loan. So, just as an example, but that's a little bit about how that program works and how the cost works and things like that. So, I'm going to go ahead and share my screen with you for the slideshow, and then I can go through things a little bit here. So, let me see. Make sure I get to the right screen here. Okay, so you should be able to see my screen here now. It says Empowered DPA Program. And so I'm going to get the first slide is just a introduction or whatever. So I'm going to go ahead and go into the second slide. So so what they do with down payment assistance, most programs are utilizing FHA for down payment assistance. So they're providing you with a 3.5%. FHA requires 3.5% for down payment, and they're just providing you in some way that 3.5% for the FHA down payment. That's how that works. Now, we do have another down payment assistance program that I'm not going to really go into detail here with. That is a really great program for people who have good credit scores and want to obtain a conventional loan. It's a specific program just for conventional loans, and in that situation, it's first time buyers only, and conventional requires first time buyers to have 3% for the down payment. And so they are providing you with that 3%, and it's up to $15,000. They won't go over that. So they'll provide you 3% up to 15,000. In that situation, that means that, up to a $450,000 purchase price. If you want over the purchase price, then most people who are using down payment assistance aren't going over 450,000 anyway. So usually not an issue. But anyway, that's a different program that I can get into on a different video. But this is FHA specific first time buyers. And this is where most people fall. This is the one we're using the most for our customers, because most customers are in that, I would say 580 credit score up to like a 700 credit score, in that range. And in most of those, you're going to be FHA is going to be the best way to go. So anyway, it says not available in Washington. Doesn't really matter. There are two special stipulations. One's Washington, one's Wisconsin. I don't do loans in either anyway, so I'm not really going to get into those. It's a completely forgivable grant. They do have two different ones, a 2% or 3.5%. We always use a 3.5% because FHA has a 3.5% down payment requirement. So why not get the whole amount if you can? May be combined with up to 6% seller concessions for closing costs. Like I said, if you get the seller to pay the whole 6%, chances are you're not gonna have to bring anything to closing. As an example, if you were buying say a $300,000 house, 6% of that would be 18,000, right? There's 18,000 going to cover everything. If you did 250, still probably going to cover everything. Most of the time, sellers are going to provide maybe 3% or 4% max. But if you can get them to go to the 6%, then more power to you. That's great. So anyway, that's a little bit about that. Here are some of the parameters, right? If you're not familiar with approve eligible versus refer eligible, I'll get into that a little bit. There's when we get your loan and we submit it through our system, we put in all your income information, your asset information. We have your credit score and your credit information in the system. We'll run it through an automated approval system, automated underwriting system called Desktop Underwriter. And when we do that, it's going to give us a recommendation. It's going to say it's approve eligible or refer eligible. Most of the time, it'll be one of the two. There are other things that it could say, but most of the time, it's going to be approve eligible or refer eligible. What that means is that if it's approve eligible, then you have a full electronic underwriting approval before we ever submit it to underwriting. Makes the process very simple, easy. The underwriter just looks at that approval and goes off that and pretty much says, okay, here are the things that we need based on what this is telling us. Very simple process. If it's refer eligible, then that's considered as a manual underwrite. And so then it goes to the underwriter, and the underwriter has to determine based on everything on the file what they want to obtain in order to approve the file. It's a more difficult process. And there are a lot of rules that FHA has as far as getting somebody approved with a manual underwrite. And so we have to go through all of that and make sure that your credit profile and things like that meet their standards when you're doing that. So what they're saying here is that if you have a 580 to 619 credit score, then they require an approve eligible to use this program. If we get a refer eligible and you're within that range, then we have an issue. We're gonna have to try to get your credit score up before we can use the down payment assistance program. If you're at 620 or better and have a refer eligible, then we can try to send it through as a manual underwrite and see if the underwriter will approve it that way. So that's kind of the difference there. There are other factors that go into whether or not you get an approve eligible. Just to give you an example, I had somebody here recently that had like a 613 credit score, And on that 613 credit score, that required an approve eligible. Well, they had some 401k accounts, things like that, and they had over $30,000 in those accounts. And the way the automated approval system works is that if you have a good amount of funds available, they count those extra funds you're not using for the closing, they count that as reserves. And the more reserves you have, the better it looks, and the more likely it is to give you an approval, an automated approval. And that's because, just to give you an example, let's say your mortgage payment is $1,000 a month, and you're going to have $12,000 in still remaining in the bank after the closing. Then they will say, well, 1,000 a month, and you have $12,000. That means you have 12 months of reserves available. So the more months of reserves you have, the better it looks. A lot of times we're going to get an approve eligible, even with a low credit score, if someone has at least 3 to 6 months of reserves after the closing, is kind of what it's looking at. So, so that's one of the big factors if you do have assets like that. And one of the nice things about this program is that you're not going to have to use much of your assets for the closing. That's going to allow you to have more assets after the closing and give us a better possibility of getting the approve eligible because of you having reserves. So that's a little bit about how that program works. I just wanted to explain that a little bit. But we know this before, we usually know this information before you even go out and find a house, because we can run this through the automated underwriting system on the front end and just make sure that we have an approve eligible. And that way you can go out there and look freely to purchase a home. So that's how that works. And then this is just some more information that basically tells you the same thing. It's the 30-year fixed loan. That's the only thing we do on this program. And then some of the stuff you don't really need to know. The maximum debt to income ratio is 50% for the program. FHA normally will allow people to go up to like a 56 or 57% debt ratio if they have good credit and things like that. But normally, if the credit score is not, at least like a 680 or better, then normally they're going to limit you to 50% anyway. So it's not really that much different than normal. They do allow manufactured homes on this program, and we actually just did one. So they do allow single wide, multi wide. They also allow condos as long as the condo is an approved FHA area. If you're not familiar with that, FHA always puts out an approved condo list, and there's certain things that the condo association has to do to be on their approved list. And so we can basically just look that up online. FHA has a site where you go and you look up the condo association and see if they're on the approved list. If they are, then you can do it. One thing that's been happening more recently is that over the past decade or so, a lot of builders have moved away from building condos. They're starting to build what are essentially called townhomes. And it's just they structure it differently as far as the documents and things like that go along with it. But if you have a townhome project or a townhome association, then it's not really much different than a single family home. You don't have to worry about these types of things as far as condo approval lists and stuff like that. So a lot of the properties out there now are townhomes instead of condos as a result, because then you don't have to be on that approved list. So that's a little bit about how that works, and the homes that are available and what you can do. Program specifications. These are the programs within FHA that you can use it for. FHA 203B, that's just a normal FHA loan that most people use. FHA 203K, limited and standard. 203K is a special type of FHA loan that a lot of people just refer to as a renovation loan. It means that you find a property that's distressed or not in great shape, and it's going to cost $50,000 to $100,000 worth of repairs to fix it, things like that. And then this is a type of loan where you can include those funds in the actual transaction. You have to get an FHA approved contractor, and so there's a lot that goes into it. The contractor has to come up with how much it's going to cost to fix it and put it into to good shape, and then the appraisal is based on the end result instead of the appraisal being based on what it's currently worth. So that's a little bit about how that works. And then what happens is the contractor will make draws on that account as they are making the corrections and repairs to the property. They can have up to, I think, like four withdrawals on that account as they're doing each portion of the transaction. And that's why it has to be an FHA approved contractors, because there are a lot of rules with it, and the FHA or the contractor has to be familiar with those rules that FHA sets. So that's how that works. And eligible programs, non-FHA loan types, we already kind of covered that. They won't allow this down payment assistance program to be used in conjunction with some other down payment assistance program. And then high balance just means it's in a really expensive area. You know, if you're buying a $700,000 house or something like that, you're probably not using down payment assistance anyway. Chances are you're selling a house and using the funds from that house to buy this house. So usually doesn't even apply. And when it says TBD, that just means to be determined. That all that means is that we can't submit this file until you have an address and a contract on a house that you're purchasing. So not a big deal there. So these are the eligibility requirements, and this is very interesting. Most down payment assistance programs have some sort of eligibility requirement. You have to be like a first-time buyer, or some of them you have to be like Florida, for instance. Florida has their own like hero program where somebody has to be a teacher or a police officer or a nurse or any of these types of categories. So there's certain things like that, and so they're going to go through this, and they will include just about any of those types of things and still give you the approval. So I'm going to go through these a little bit. So to be eligible for the program, the borrower must meet one of the four categories, not all four, just one of them. One of them is either a first-time buyer or a current retired employee or volunteer non-paid member. And I'm going to go through what all these means in the next slides. They must meet income eligibility, or they must be in an underserved census tract. So I'm going to go through each of these one by one to explain what it means. First of all, first-time buyer. Most people think first-time buyer means that you've never owned a home before. That's not the case. First-time buyer simply means that you haven't owned a home in the last 3 years. So, here are the stipulations for first-time buyer. To meet this criteria, you're purchasing the subject property. You'll reside in the subject property as a primary residence. Usually FHA requires you to live in it for at least a year. Then has had no ownership interest in a residential property during the 3-year period preceding the date of the application, or is an individual who is a homemaker or single parent that has no ownership interest in a principal residence other than a joint ownership interest with a former spouse during the 3-year period preceding the date of the application. So that means if you went through a divorce or something like that, you owned a home with a spouse, but you don't anymore, then they'll still consider you. So that's how that works. Additionally, one other thing that's a little bit different here too is that when you're talking about any of these criteria, is that only one of the people in the application needs to meet the criteria. Normally, with down payment assistance programs, both people have to meet the criteria. But in this down payment assistance program, only one person has to meet the criteria. So if you were a first-time buyer yourself and you're buying it with somebody who owned a home previously or whatever, then you can still qualify. They also allow a non-occupant co-borrower. So let's say you're a first-time buyer yourself and you're buying the house with someone else who's not going to live in it, and they currently own their own home. You would still qualify, and they would just be a non-occupant co-borrower. And the reason some people put a non-occupant co-borrower on is because they don't have enough income on their own to qualify. So the non-occupant co-borrower goes on. You get to add your income to their income, your debts to their debts, to recalculate the debt ratio. Debt ratio is much better with the non-occupant co-borrower, so now you qualify, if that makes sense. So that's a little bit about that, but that's the first-time buyer portion of it. Now, when it says current retired employment, this is the hero part that I talked about. So any borrower on the loan application is a current retired volunteer or non-paid if they are military, if they're a first responder like police, firefighter, public safety officer, paramedic, emergency medical technician, or similar. If they're an educator, school teacher, tutor, daycare provider, medical personnel like a nurse or a doctor, x-ray technician, etc., or a civil servant in federal, state, or local municipality. So those are the categories, and to meet that hero standard. And then, and like I said, you only have to meet one. So if you're a first time buyer, you don't have to be a hero, right? Or if you're a hero, you don't have to be a first time buyer, et cetera. Income requirement, right? So there's an AMI lookup tool, and this is average median income is what AMI stands for. And so what they're saying is that the borrower's income on the loan application collectively is equal to or less than 140% of the state or local median income, regardless of family size. So, this lookup tool allows us to go in and see what for that particular address, what is 140% of the state county median income. If you're under that, then you meet the income requirement. And that's even if you're not a first time buyer, you're not a hero. If you meet the income requirement, you can still use the program. So, and then finally, the last one is underserved census tract. And when we talk about underserved census tract, it's hard to kind of explain what that means, but it basically means, some of the underserved census tracts are really, gosh, how do I explain it? Usually they are in kind of an impoverished area, I guess you would say. The underserved census tracts, kind of an impoverished area, and it's difficult for people in those areas a lot of times to obtain housing. And so the federal government has classified certain areas as underserved census tracts so that we can have programs to help people buy property in those areas. And so that's the other possibility. If you're in an underserved census tract, or if the property, not if you are, but if the property's in an underserved census tract, then none of those other categories even matter. You can use this program no matter what the other things are. So so that's a little bit about that. And this we don't even usually look up because most of the time people will fall into one of those other categories and we don't even have to worry about the underserved census tract and where the property is located. So anyway, that's a little bit about how that works. And then we don't have to worry about this stuff here, geographic specifications, because I'm not doing loans in Washington State or in Wisconsin. So that's pretty much it. There's a bunch of other slides, but they're more specific to the lender or the loan officer, and they don't really mean anything to you as far as that goes. So I'm gonna go ahead and stop the share there. The other thing that I wanted to cover though before we're finished is kind of how the disclosures and things work once you start the program. It really confuses people because when we start out, the lender, which is EPM, they will send out a loan estimate. The loan estimate is going to show numbers on there that are inaccurate, and that always messes people up because they don't put your grant on there initially, and they also don't put if the seller's covering closing costs on there. So just to give you an example, I had one recently where they sent out the loan estimate and it was showing that the customer is going to have to bring $22,000 to the closing, right, on the loan estimate. And so it freaked the customer out, but that's because they didn't have the grant on there or the closing costs on there yet. They don't do that until after they start underwriting the file and get the approval done, and then they will change those numbers and update them. And even after they update them, they're still using estimates, and they always estimate certain things high. And the reason they do that is because they have to put anything on there that the title company might charge, they have to put on there as a fee. Otherwise, it can't be charged at the closing and it creates a problem. So they will estimate several things on there that are high that are going to end up dropping off or dropping down. And so just to give you an example, 22,000, I think that one was like 22,000 on the loan estimate. the customer ended up bringing like 7,000, if I remember correctly. So it was like a $15,000 difference because of, they had like I think it was like 7,800 was the down payment, which was provided to them through the grant. Then there was 5,000 the seller was paying, so that put them up to like 13,000 something. Made that much of a difference, and then um, there was still a couple $1,000 difference in the estimate itself as far as how much they were overestimating. So just as an example, it was showing like 22,000, only ended up having to bring 7,000. And if that had been a regular FHA loan without the down payment assistance, then they would have been bringing about 13,000 to closing if they were paying their own closing costs and down payment. So just an example. So it's still a very good program, and means you're going to have to bring less. It's also easier to get approved because you have more reserves. And so um, that's a little bit about how that program works. Now, the other thing I wanted to cover too, and I always like to let people know this with down payment assistance programs, I always tell people try and be a little bit patient with it because the approval process typically takes a little bit longer. Um, the underwriting's a little bit longer, and therefore the approval process is a little bit longer. Usually we can get loans closed a lot of times within a couple of weeks, but with a down payment assistance program, it's closer to 4 weeks because it is a longer process. And I always like to let people know that on the front end as well. But that's pretty much it. I'm going to go ahead and sign off here now. But if you do have any comments or questions or anything, certainly feel free to reach out to me. If you do want to go ahead and get approved for the program, you can go to timdial.com. That's the loan application. And then we can start working on getting you approved for the program from that. And that's pretty much it. I will talk to you later. Thanks. Bye.